Pete Carmesito, welcome back to the show, sir. It's good to see you again.
Thanks for having me. It's great to be here. It's been a while.
Yes. Actually, it's been a little while. It's been since February 26th, 2024 was the last episode featuring yourself. And, you know, it's time to catch up.
It's amazing how much has happened in between that time.
Yeah.
That's why it feels long.
It is. It is. But just before we hit the record button on this, you did mention that last time we talked, we had discussed things like the unemployment rate and the potential for the Federal Reserve to cut rates, which, you know, they've signaled that they absolutely will do, and now it's just a matter of by how much.
Yep.
And the meeting is just within days here of when this podcast goes out to the world. So I imagine that you have more thoughts about this now than you did in February, right? I mean,
yeah, it's something I've been tracking for a while. I mean, it's bond related. It's obviously interest rate related, but it's also, the fact that, I went back and just did it was a simple study, right? I just wanted to see, when did the Fed cut rates last time, and then all the previous times, and what was really happening in those scenarios. Mm-hmm. And typically the Fed doesn't cut rates because things are going great. They typically cut to stimulate. And it mostly, if not every time, correlated with an uptick in unemployment. And we got that in August. And then the last one, just the most recent one, saw a downtick, but it was sort of suspect, right? Because there's a lot of revisions to the downside. And even since we've met here on the podcast, the revisions for the previous year were even astronomical, 800,000 less jobs reported, or more jobs reported than should have. So, it's hard to kind of nail that number, but I do want to point one thing out. We saw 4.3 in August, but that's rounded up. It was 4.26. And this last report was 4.22. So it was a 4 basis point move, not a 10 basis point move. A lot of people go, you're splitting hairs, but that makes a big difference. And certainly, I think the Fed is going to be paying attention to it. They kind of got painted into a corner here. And to me, we already kind of know this. Bonds have rallied. REITs have rallied. A lot of these sectors we're going to talk about today have rallied. They're interest rate sensitive sectors. And they're basically forecasting what the Fed was going to do. It's the same thing that happened at the end of 21 and beginning of 22. Bonds were falling out of bed, raising rates way before the Fed even acted. So I think it's it's just a reverse. And I believe bond managers, when I say bond managers, I don't mean the institutions. I mean more the financial advisors that are trying to manage individual accounts, things of that nature, are still struggling with the bond timing here. But I mean, bonds have really kind of foretold really what the Fed is probably expected to do. Now it's just a matter of how much.
What do you think about the Sahm Rule? Because, you talked about like a few bips change here and there in the actual unemployment rate, mm-hmm. but that moving average has, it bottomed and it's moved up by, 0.5 plus, that's when it gets the trigger. And the Sahm Rule says, it doesn't say there's going to be a recession. It says we're in one now.
That's interesting. I love that, actually. I kind of feel that, right? I mean, not personally, but looking at all of the charts I look at, and we're all in the same spot here. We look at hundreds of charts a day. I know I do, and I'm sure you guys do too. It is, it's just amazing how things are. You look back and you can say, all right, well, what would really be happening if there, quote unquote, was a slowdown? Well, things like lumber and copper might go down. Well, go look at a lumber and copper chart. They're down this year. So, things start to materialize. And I made this saying up. If I didn't, somebody can fact check me and then at me somewhere out in the universe. But dominoes have to fall in a row. They don't fall out of order, right? So one doesn't fall, then 6 dominoes later, the next one falls. It has to fall in a row. And that's why I think you start to see that business cycle that we talk about, whether it's early, mid, late, or contraction/recession. Where are we in that cycle? It seems like we're between we are either at the end of mid or the beginning of a late cycle, and maybe it's accelerating, and that's part of that reason. But that Sahm rule is very interesting, and it obviously is tied to unemployment as well. And I don't think it's a coincidence indicator. I think it's a great indicator. And then what else happened? You had we had this inverted yield curve that just, is it disinverted or uninverted? I'm not exactly sure.
Yeah.
So that went positive as well. So, guess what? That typically, again, another domino that's falling based off the other ones that are already signaling things. Again, you had bonds move, you had the dollar come in, right? Dollar's gone down. So when that's happening, typically rates are going down, and they're very highly correlated. And then you can throw in what happened in Japan there for a couple of speed bumps along the way. And lo and behold, what do you get? Volatility. And that's kind of what we're seeing. So we're seeing these massive up days, and we're seeing massive down days. And to me, that's just uncomfortable. It doesn't seem, it's not a fun time right now, but if you're disciplined and you've been rotating because of what price analysis has showed you and things of that nature, you've kind of, weathered the storm pretty well.
Yeah, I've noticed oil prices trending down the last couple of months as well. And I wanted to get your thoughts on just a little bit more on employment or unemployment too. I've found, and I don't know if you've found something similar, the history of the Fed just underestimating how high the unemployment rate ultimately goes in a recession or a slowdown, or when they are at a point like this where they're thinking about cutting rates. It generally, I found at least, gets worse, much worse than they are anticipating and have projecting.
Sure. Absolutely. You're right. You're spot on. And it's that speed, right? I wrote an article that came out on our Power feed September 10th, and it's called "The Fed Might Break the Speed Limit." And in that regard, I was talking about how fast they might cut rates, right? And what you're saying is because they might have to catch up to a speeding unemployment rate as well. So they're going to have to break the speed limit if they're seeing something that, for whatever reason, we don't have access to, which I don't think that's possible at this point in 2024. I feel like information is flowing, from every angle times 10. But at the same time, we do see periods of announcements, especially in the tech sector. Take Google, for instance. They laid off just hundreds of workers, but then Amazon comes in and joins the club for layoffs as well. So did Dell, 6,000 layoffs earlier this year. Apple, and you start talking about the financial sector. So is Goldman, Citi, and Deutsche Bank. They all had job cuts. So you're talking about an estimated 60,000 plus job cuts across 254 just technology firms in 2024 so far. That's kind of dated already, right? Since then, it's probably increased since I compiled those numbers. But at the same time, that there's a reason for that, right? That's kind of sneaky, and it kind of, people are paying attention to it, but it's hundreds here, a few thousands here, and then all of a sudden it starts to add up very quickly, because a lot of these are headline news, right? Google, Amazon, Dell. When those folks make some changes, we hear about it. But there's plenty of other names that we don't hear about, and I think that's where it gets. Again, it's very fast, and I think the Fed is, I guess, pressured in a way, but potentially, the Fed Chair Jerome Powell is very level-headed. I think he's done a great job as far as communication. He's not been right all the time, but he has told everybody what he was going to do, and I think he's stuck by it. He's just very dovish. So a lot of people are worried about a 50 basis point cut. It would be possible, but I think he's at 25 and multiple 25 cuts to start, unless that unemployment rate gets out of control. So you're right. I think the unemployment rate could press the Fed to move faster. And I think there's a problem with that.
Yeah, two things about that. One, they certainly broke the speed limit on hikes, right? And we're late to the party on hikes. So would it surprise us, on cuts for the exact same thing? Late to the party, breaking the speed limit. Shouldn't surprise anyone. What I want to know, do you think if there's a 50-point cut baked in, will the market look at a 25-point cut sort of as hawkish?
As 25 points. Yeah.
You know
You
what I'm
know
saying?
what? They
Yeah.
could. Yeah, they could be. Yeah, because that's just. I think that would be more from a perception standpoint, right? In other words, it's like, yes, we cut rates, just not as much as you thought we needed to, kind of a thing, because they might want to tweak that dial. I get that to a degree. Anybody who's into music knows if you change your bass or treble or volume too quickly, you might blow a speaker, depending upon what's on the radio, what tune is playing. But at the same time, 50 basis points is, I think, both mechanically and emotionally disruptive, meaning that mechanically the markets need time to adjust to higher rates. But if he does 25, I don't think it's out of the question. It might be a little goofy because it's an election year, but it may not be out of the question to do an intermediary cut between meetings, because I don't think there's a meeting in October. Is that right? So he might have that kind of ace in the hole and says there's no meeting, but we can still cut in October. So he might get 50 off the table before the election, and I think I think he's probably going to. He might test the market because of that. He might go a quarter and then see how the market reacts. You're right. Could be hawkish, but I don't know if 50 basis points is the right one. Some people are talking about 75 is on the table. I know it's a low percentage,
Right.
But we heard, a famous professor from Wharton calling for an emergency, rate cut, which we didn't need. That would be a terrifying event. But at the same time, I think they're kind of trying to thread the needle. It's hard to do. I mean, I'll give them that piece of credit.
I don't know.
Anyway.
I don't know why
that's
that
where my
guy
head's
is
at.
famous.
Me neither. He attracts a lot of attention, I guess.
On a Monday morning, emergency. It's emergency.
We have to cut rates.
We have to cut rates. Yeah, that's where my head's at with this. Like, there's a lot of uncertainty whether where the unemployment rate's going to go. I mean, what the Fed's going to do, 50, 25. It just seems to me like this period, the next couple months through the end of the year, should expect volatile swings. I mean, we're seeing it almost daily, depending on if there's good news, bad news.
Yep.
What are your thoughts on?
Go ahead.
Yeah, go ahead, Dan.
I just have another question. Like, if in macro, as a recent guest Bob Elliott pointed out, in macro, having the divergent viewpoint, right? Figuring out what everybody expects, and then finding a realistic way to assess that maybe something completely different is going to happen, and being right about it. That's where you really, really can make your macro chops shine. So nobody is talking about anything else but how much is he going to cut, 25 or 50? And, Mr. Wharton, 75, whatever. And that's what the world is obsessed with at this moment. I wonder what's the divergent viewpoint there? 100 basis points, 0. He says he's going to cut.
I don't think that would be reminiscent of the 90s, right? When you get an emergency Fed, rate cut. I mean, that would be markets and turmoil shows all over the place.
Yeah.
It wowould be totally disruptive. Yeah. I think the wild card is Japan. I really do. I think they're unwinding, where they've got to raise rates and protect their currency, even though our currency's come in a little bit. Their currency has risen in recent months, and I don't want to call it a safe haven, but it's been the better performer in the last 30 some odd days than most other currencies. Yet at the same time, that was kind of what jarred our markets there for a couple of days in the beginning of August, right after the Fed did nothing. Now imagine if he had cut there, right? That would have been, I think it would have exacerbated the sell-off. But Japan sold off 12%. Like that was like one of the worst days since 1987 for Japan or something. And then rally back 10. And to your point, Corey, we're seeing these back and forth movement. You get these bookends, right? You've heard this myth: if you miss the 10 best days in the market, blah, 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 you'll underperform. Well, people forget to tell you that the flip side of that equation is they're bookended by sometimes the 10 worst days in the market.
Yeah, they happen right next to each other. Yeah.
Literally right next to each other. It's insane. And so it's hard to kind of ferret out, like, all right, is that something that is this a buying opportunity, or am I just seeing a bounce and then am I going to see lower lows? That's where I think technical analysis comes in. When you start to see a series of those lower highs and lower lows on any chart, whether it's an index, an ETF, or an individual stock, or a commodity like copper, lumber, things of that nature, those trends persist. And I think that's really what we're starting to see. Like, we'll get into sectors and things of that nature that we're seeing here at Chaikin. But I think at the same time, you've got to realize that, yes, rates are going to be, for me, it's always been the three-legged stool. It's rates, bond prices, and the dollar, right? This is what's driving, it's the cost of money, right? And how much you're willing to be either in debt at what rate, or how much you're willing to purchase debt at what rate. And so I would think that, if you saw what we did from the Treasury standpoint, we issued a lot of short-term debt really fast, right? Why? Well, because that was an easier thing. We had buyers there, right? Because apparently they wanted to be paid more for their risk. So again, that's a macro kind of view of the bond market. But at the same time, I think we have to be cognizant that rates are going to drive volatility and returns, and that's driving sector rotation right now. You're starting to see tech and semis and things of that nature take a breather. And what's rallying? Utilities, staples, REITs. I mean, it's not a secret. It's out there, right? Everybody can see it if you just look at a performance chart.
You mentioned semis. I mean, there are breathers and there are frickin' breathers. I mean, that's a frickin' breather, right?
That's a halftime.
Yeah, that's a halftime show. It's like, Janet Jackson for a half an hour.
Right.
Yeah.
It's true.
And,
it's true. I mean, and you're starting to see topping formations in the VanEck semiconductors symbol SMH. You're starting to see little topping formations. And again, they can surprise us, right? I mean, obviously they've done this. They've always surprised me when they rally to levels that are just unfathomable. But, if you're not in them, you're not in the best part of the market sometimes. But sometimes they turn tail on you pretty quickly. So that's the risk is, again, those 10 best days, worst days are surrounded, they bookend each other. Don't get caught looking at the waves. Look at this underneath the surface and see what's going on, because things are changing there too. So again, I look out for lower highs and lower lows and a period of breaking long-term trends. That's just the beginning potentially of a trend change or turning point in the best performing sector sometimes.
All right. You mentioned all the things that I've been thinking about. Japan, the rotation into defensives with staples, healthcare, bonds. I don't know what else to talk about right now, but it's I guess how do we know, or how is a person to know if this rotation and the sell-off in semis and some of those, the popular, the mega cap tech that we've been seeing for the last couple of months, versus the more boring, defensive sectors? How are we supposed to know if that's just rotation within a bull market, or whether it's turning into something different?
So, sometimes I could be the most bullish bear you'll ever meet. And I find opportunities that are bullish inside of whether it's corrections or pullbacks or whatever a bear market, determination is nowadays, right? We just had a massive 15% pullback in the QQQ, right? The NASDAQ 100 rather quickly, right? But yet it turned around and came back to levels, except it did not make a higher high. Neither did the S&P 500. So that right there is the first tell. Again, the dominoes have to fall in order. I think that's sort of the takeaway today. So when you start to see those trends either break to the downside and fail to rally to new highs, while these defensive sectors are basically coming on the field, right, replacing the offense, so to speak. It's football season. So you start to get that feeling and the understanding that, okay, things are getting a little toppy here. So I always look at, we have to remind ourselves, and I think I forget a lot of times, is that these indexes are cap weighted, right? So the Qs, they're being driven by the Mag 7, whether it's on the way up or on the way down. And that's kind of what's happening here. So when you start to see staples, right, XLP, we'll take that, the spider sector ETF. that's starting to outperform S&P and the Qs. And when you start to see that, to me, that's an area to be defensive. Now, things can change rapidly, especially in an election year. I don't know if you remember, rewind 4 years ago, or more than that. Well, I should say 8 years ago now, when Trump got first elected. I think the futures market fell, who knows, 900 points, 1,000 points that night. And that was
Dan
like the biggest.
That was one of Dan's favorite nights.
Oh god.
Yeah, and that was a famous investor, Carl. I kind of think left the celebration party to go buy, go buy the futures because he was like, this is wrong.
Best crisis ever.
Yes, honestly. And so this is what I'm saying. So these things can have that capitulation moment unexpectedly. Remember, we also saw a few Christmas Eves ago, it was a slaughter at Christmas Eve. It was down 600 points on the Dow, things of that nature. Yet that turned out to be another buying opportunity. So I think that there's always opportunities somewhere. To your point, Corey, how do you know whether we're in that turning point? I always think that that's really our job as sort of market participants and market strategists like myself, is to kind of find, where are we going, right? Where's the wind blowing, and how do we adjust the sails to get to our destination, which is profit land, right? That's where we want to be. So we have to be cognizant and understand that these stocks aren't our friends. And sometimes you bet against your best friends, whether it be tech or semiconductors or software, whatever the case may be, and you move into utilities. And I want to make a point that utilities, staples, and especially REITs are really bond proxies, if you think about it, for those institutions that are equity, mandated to own equities, right? That's in their charter. So they can't buy bonds. Well, guess what? They replace those with utilities, REITs, and staples, and even really high dividend paying stocks as well. There's some household durables that are part of that, and consumer not discretionary, but consumer staples spots. Like your Procter and Gamble's, your Clorox's, things of that nature. They're being bought because they do have a nice dividend and they are a safe haven, and they've underperformed. So they've got they check 3 or 4 boxes pretty quickly. I don't want to call them value traps, but at the same time, they might be great opportunities, for the next 3 to 6 months before the new party starts.
Yeah, I'm sitting here looking at an epic rally in XLU, the utilities spider sector fund, from about 60 to about 77 as we speak, which is, these are utilities. Amazing. I mean, that's a rocket in utilities.
Yeah, utilities is interesting, isn't it? Because it's typically defensive, and it is again, but then it also was riding this like AI wave before. So
the data centers. Yeah,
the data center. So it's I don't know how to think about it anymore.
Well, it has one other aspect that, again, I tend to forget when I do the research. So I go, oh, that's right. And that's they're just domestically based, right? There's no foreign currency issues there, right? Mm-hmm. So that's another, positive, especially for them, and REITs for the most part as well. So I think that there's a comfort level there, and there's a tailwind, especially into a scenario where rates might continue down back to what level, I don't know. Again, the unemployment rate will determine what level rates go to, right? So interest rates go to. So
utilities that's
going to be a show worth watching, I would think.
Utilities are a little tough for a value guy. I mean, XLU is like 23% Next Era and Southern, and they're 3 times freaking book. I mean,
I know. Look away, you'll turn.
Look away. I know. It's just like it's tough. It's been,
look him in the eyes.
To be fair, it's been tough for me, the whole way up. So I cop to that instantly. I don't pretend, but yeah. But I've been in staples and healthcare for a while, so I'm ready for them to start moving as they have. But utilities, I could just never do it. I just couldn't do it. Yeah.
They're hard. I mean, honestly, there are. And then the ones that you do find that might be more value oriented, from that, price to sales, price to book, whatever you might be looking at, or even PE ratios, then you start to wonder, why are they down so much?
Yeah.
what are they missing?
Right.
What did they miss? Are they doing something wrong? I doubt it, but they might be in less populated areas. They may not have exposure to the data center. There's a myriad of things that could be happening in there. But I love the data center thing. That's been something I kind of grabbed onto early this year, found some opportunities, and then that kind of changed rather quickly. Obviously, when I guess it was more political than anything, right? Because if we're going to go back to lower energy prices, let's say if Trump is elected, obviously he's going to drill, baby, drill. That's the mantra. And yet at the same time, maybe that's why oil's pulling back. We were talking about that earlier. We're seeing oil come into the buy zone, right? I started a chart. I don't know. It was I can tell you the day, October 22nd, I think, or it was October 18th of 2022 is when the White House made the announcement, which is kind of a silly thing to do if you're going to be buying a massive commodity. Yeah. They told the world, we're going to buy between 67 and 72. Well, guess what? Oil has rarely got below 67. And when it's been above 72, it's not above there very long. Yeah. But it is trading there at the bottom of that range right now. And I believe I counted this correctly. It's the 7th time since they made that announcement that it's got back to 67. So I don't know if that's in any textbooks as far as, 7 bottoms. I don't know if there's an 8th bottom coming or not, or a bounce up. But the point is
somewhere probably. Yeah,
there's got to be, right? I mean, if they're not hitting the buy button here, what are they actually saying by that?
Yeah,
right?
Actually, Pete,
refill this SPR.
It's this famous septuple bottom.
Yes,
that's right.
Very well-known chart formation.
Oil put bottom.
That's right. Yes. Just discovered in the ex-Roman Empire.
The White House put bottom. Yes.
That's right. Yeah,
that's right. But I'll send the chart over to you guys after this. But I think it's pretty interesting, and the trend. If you look at price action and even moving averages or whatever indicator, I know you guys I'm more technical most likely than you are, but at the same time, that trend looks lower. But again, 67 has been sort of the backstop. And I guess markets are testing that level for that specific reason to see, are there buyers there? We know from price discovery, being traders, been in this business for a long time, price discovery, they test levels to see if are there any buyers here? If not, how about 66? Any buyer? How about 65? Well, maybe there's a slew of buyers at 65 and that starts to push the price back up, but it comes into production and OPEC and, there's obviously disruption over there from a geopolitical problems. So you name all of those, and oil seems to be going, well, it's been lower. So it seems to be shrugging off all those issues.
Yeah. Pete, I need to go back and talk about something for our listeners' sake, just to clarify it. And you talked about the dominoes having to fall in the right order. Can you be a little more specific about that? And,
Sure.
Just sort of tell us exactly.
Well, I mean, you're talking about unemployment, right? So, we started to talk about that trickle effect. In other words, it starts off by hundreds and then all of a sudden the headlines go to thousands, right? Then you start to see, well, copper, they call it Dr. Copper for a reason, right? It's got a PhD in economics, apparently. And copper topped out in May, I think it was May 21st this year, has been slowly moving lower, but persistently lower. Then you see lumber prices lower. So does that mean, is there demand destruction? I would imagine at certain rate levels, yes. So the dominoes are falling. You started to see, again, it seems like it's not a falling domino because I'm talking about something going higher, but utilities, staples, REITs, all moving higher right around that same time frame was when they really started. But I would say for most of the year, they've done extremely well. But for the last 6 months, they've outperformed most of the major indexes. So now you're looking at that, those dominoes are all kind of falling in an order. And all of a sudden, here comes the unemployment rate ticking higher and the Sahm Rule. And then guess what we're going to get? Rate cuts. And so all of these, and the dollar has come in a little bit, and then Japan is on one. So all of these things are being manipulated by one another. That's the cycle that we can't control, the business cycle, as much as we like to think so from a monetary policy. Things are happening out of our control. We have to react to them. The mandate of the Fed is 2, price stability, and that doesn't mean stock prices, and unemployment, low unemployment. So they've failed, it feels like, on price stability, because we're looking at, you know, prices 20% somewhat higher in just a few years, even though they're getting to their target inflation rate. But now unemployment's moving up. So once the scale only stays balanced for a few weeks, it seems like, because one's either moving higher or lower, and now you got unemployment racing higher, to our point earlier. Where does it have to get to where it's one of those emergency rate cuts? So those dominoes, I think, have been falling one by one, and sometimes they don't make it all the way through, right? We've seen fits and starts. The market has ebbs and flows to it, and then something really positive comes out, NVIDIA's new chip, it's going to change the world and cure cancer, and all of a sudden, you know, Ozempic comes out and says, you know, everyone's going to lose weight, and we have an AI tool. I'm making that up. My point is that all of these headlines are, you know, people run and they see something shiny and they go after it. It pushes indexes up, it pushes up sectors, but under the surface, I was talking about that riptide of the market, things are moving into place. And it's like a chessboard, right? Your pieces are where they need to be to win. And I think right now the next move on the board is rate cuts, and potentially we've got CPI coming out again. You know, that's going to be sort of a measurement that the Fed's going to have to pay attention to too.
Right. I mean, they claim to focus squarely on PCE, but we know they're focused on the headlines. So
they love headlines.
Yeah,
they love to talk too.
Right. And they love to look backwards at data.
Yes.
Like, look at all that data back there. I guess we better do something.
Yeah.
Yeah. So it sounds like, I mean, just making it more concrete in terms of a trade, it sounds like you like staples. Like that's one of your trades right now.
Yeah, we've been migrating, you know, and I always talk it's a migration, right? For me, it's always like a stair step, right? Not so much a fireman's pole, right? You don't get down, you don't rotate that quickly. You stair step, right? You're topping out on one sector and potentially turning up on another one. And to get those two, that timing right perfectly, it's almost impossible. But, you know, as the clock goes, 12 o'clock's the high, 6 o'clock's the low. If I can get in at 7 or 7:30 or even 8 o'clock, I'm happy. And if I can get out at 1 or 2 o'clock, I'm happy there too. So I don't have to get the top or the bottom. But yeah, we've been slowly migrating, you know, our subscribers and our readers into something that's a little bit more defensive, but not letting go of some of the more growth oriented areas. And you might see software might start to perform better than hardware, right? So that's a little bit more sticky. It's more of an annuitized business. You saw, I think Oracle just came out with nice earnings. You know, Adobe's kind of firming up. So those types of names are, you know, they're feeling a little bit, I would think more opportunistic, but still, it's not an overweight situation. It's not let's go in and grab every share we can. It's like, yeah, I'll take exposure, but I feel like I can get it lower as well. So yes, staples, utilities, and REITs have been flashing on my, you know, I use a screener, and they've been coming up every time. Like, well, there we are again. Here's another REIT. Here's another REIT, and it's widespread. It's from office, it's retail REITs, specialty REITs like data center REITs, and even you know, healthcare REITs have done really well. Mm-hmm. But you're starting to see residential and even some office REITs, as I said, which was surprising to me. I think that's more of an interest rate trade rather than, you know, a quality trade. Yeah. But I think it's the tailwind is lifting, and even some high dividend paying, you know, like the dividend aristocrat, you know, list of names. You know, they have at least firmed up, depending upon what industry they're in. Some are better than others.
Yeah. Speaking of interest rate trades, housing is sensitive to rates. Yes. And the home builders, of course, just before they really took off like a rocket recently, I sold them, of course, mm-hmm. You know, every single time,
yeah.
Right?
You had to, right?
Yeah. Right. Because if I didn't sell them, they wouldn't have taken off.
They wouldn't have gone up, right?
So
you did it for everyone else.
Yeah, I took one for the team. Everybody else's team, not mine. My team's looking at me thinking I'm an idiot right now. But so, you know, the situation is still the same. Like, you know, existing home sales are like nowhere. They're basically non-existent. You know, existing homes are not existent in the market. And I just wonder about, among other things, the potential for lower rates to, kind of increase that supply of existing homes, because the lower it goes, when if it gets down around 5, if the mortgage rate gets down around 5, that's where that huge block of folks who feel trapped by their mortgages begins. It goes 5 down to 3 and sub 3. Some of us,
Mm-hmm. Yeah, it's true.
it's just I wonder what that supply demand balance looks like, because it's still super tight. The market is still very tight by any measurement. And
I think as real estate investors or owners, and look, there's a lot of people who own second homes, right? I mean,
yes.
that's really, there's a lot of these homes that aren't even on the market because they're vacation home, they're family homes, they're homes that have been passed on to generation. But there's a lot of homes that were just purchased in the last 4 years because of rates, because of the work from home, work from anywhere, right? Because of potentially not being able to do something in one state when you could do it in another. More freely, whether that's, go on a boat or go to a restaurant or whatever it was back then, right? Because of the pandemic mandates and things of that nature. So that played a huge part in it. And obviously rates went higher. So they're kind of locked into them. But if you start to do the math, and I look at this from a standpoint of payments, right? People buy a payment, they don't really buy a price of a house. So if they can afford it, it could be that the house that's $580,000 today, right, at one rate, it might be the same payment if the price was $625 at a lower rate. They don't care about that price. They care about that payment. So that, to me, is the best of both worlds, because the buyer can still get the payment they want and the seller can get a higher price. I think that's what we're going to see because of rates coming down. So to me, that unlocks an opportunistic time frame or period for both the buyer and seller. That's also threading the needle, but at the same time, it's not the right time of the year to be a seller, right? It's typically spring, definitely somewhere through the months of summer, where folks are moving and trying to get their kids into school systems, things of that nature, right? First time home buyers, whatever it might be. But there's a seasonality to real estate, and I think the season probably might come a little early this year if we see rates. I mean, some people are saying, we can see 100 basis points, lower before the year's out. That would be amazing to me. I think that would prove beneficial for the January through May months of real estate in that sector. So I think what's happening is prices might increase slightly or not fall, where the payments might get better for folks to pay those current prices. But you can't deny the one thing. You are seeing a softening in real estate prices in the last 6 months or so, maybe even this past year. So, there's an equilibrium. Some people are coming off the cloud prices a little bit. You're seeing prices tick down, but rates have stayed firm. Now buyers are acting, but if rates come down further, they're going to act. I think you're going to see more houses for sale.
Yeah, it's I wouldn't ask anybody to make a big prediction. It's just sort of, what's more likely, and I think that idea of threading the needle makes a lot of sense.
Yeah,
and certainly we know lower rates. We know lower rates, higher asset prices, like generally, right? Generally,
typically, right? So, you would think that money, when the cost of money goes down, asset prices are supposed to go higher. But again, if you get oversupply, we know what happens there. So that's that threading the needle. We don't want to see a flush of new real estate for sale either, right? Because now, what is that? That's a buyer's market, and in a buyer's market, prices go down. So that's that extra sort of, what's the word, outlier that could potentially disrupt the market a little bit. We don't want to see that, but at the same time, we do have a housing shortage in this country, and builders have done extremely well, as you noted.
Yeah.
And even some of the suppliers to these builders have done well. But I'm seeing a rotation to the downside in some of those areas as well. Typically, and mainly, I should say, is machinery. That specific sector has come up on my radar just recently in the last several weeks, as showing me negative relative strength to the S&P, which means it's underperforming the S&P, and that typically means a lower price for those asset or those sectors.
Right.
Interesting.
Yeah,
I got to tell you from one more thing on real estate and home builders. The fundamental case, I think, guys, for home builders like is not going anywhere anytime in my lifetime. I don't think. Maybe it's fair to say. Like I have friends around here and in the housing market right now, and like the only houses that are being bought, at least in our area, are like going like all cash deals right now. Like it's
still,
and it's just extremely tight. Even if you can afford, you're getting, outbid by somebody who's got all the cash for it. And so I still, if rates go down, to me, real estate's local, of course, but it's gonna unlock, I think, more activity on balance than maybe more
demand
housing
than
prices.
Supply.
Yeah.
Well, that I don't disagree, and I think there's something, and this might come out of left field a little bit, but there's something that I've been kind of thinking about and understand, and the question is being raised by what you just said. Where are these folks coming up with this cash? In other words, first time home buyers walking in and buying a house for $500,000. That's typically not normal, right? Is that what you're saying when you said they're cash deals, or are they just kind of across the
not necessarily first time, maybe second time, but they're getting help, right, from other family members, from their retired family members who have a ton of assets built up over time and are helping out, and that's the only way you're able to get it.
That's exactly what I'm getting at.
Yeah.
And that's because the lifetime gift estate tax exemption is changing. So people are forwarding, paying forward. In other words, allowing folks to take the gift while those folks are still alive before the limit is reduced in 2025. So it's currently, last year it was 13.6, and I believe it's going to be projected down in 2026 down to be 7 million, right? It's almost half of what it is. So I think that's part of why we're seeing more cash transactions, especially in hard assets rather than specifically equities as well. So yeah, I think there's an accelerator. Now, imagine if that changes, right? And imagine if there's a new party, well, let's say it's Trump, and he extends or even increases the lifetime gift exemption. You might lose those buyers. So I think there's another piece of the puzzle there. It's very small, but it does affect certain markets, and real estate will be one of them.
That's interesting.
Right. So explain that to me again, like I'm 5 years old.
So if you're, as Corey said, there's folks who have, obviously have accumulated enormous wealth, right? Mm-hmm. And you get to give away tax exempt gifts to anyone, really. Mm-hmm. Typically, it's family members. Mm-hmm. So if you're, Daddy Warbucks, and you sold your company for $60 million, and 4 years ago, and you happen to invest it, and now it's worth $100 million, and you got 3 kids. Well, you can give each one of them up to 13. If you haven't given them anything, I'm sure they've given gifts along the way, and that's obviously from a tax standpoint. And this is not tax advice; it's just a general rule.
Gotcha. That
you have a certain amount of money you can give to someone who receives it tax exempt, and there's a lifetime limit on that. That limit in 2024 was $13.61 million. So you can accelerate gifting while you're still alive, right? Lifetime gift estate tax exemption is what it's called. And that is obviously new money, and new money buys things with it. So
okay, I got you.
Whether it's houses, cars, vacations, you're seeing a lot of people take, tremendous vacations, and maybe buying these second homes in places like Florida, where I'm at, and maybe even, up and down the East Coast, the Carolinas, things of that nature. Or even as far up as the New Jersey, beachfront properties as well. So, which have done incredibly well over these past 4 years. So there's a little bit of that happening. And so if mom and dad have accumulated a lot of assets and they want to see their kids use it and be proud of it while they can watch them accumulate it and use it, and using it respectfully most of the time, I think that's what Corey was getting at. You're seeing people come in, boom, cash down, no negotiation, close in 3 weeks. You know what I mean? Remember, you used to buy a house; it would take months to buy a house. Yeah. People are buying houses in weeks.
Nobody wants to do that. Yeah. So.
It just makes me wonder, like, what kind of an economy would we have if the incentive was to accumulate and invest productively large amounts of capital instead of chopping it up and giving it away before the government steals it? What would we be? And if we measured economic growth and economic health in terms of, capital formation and the investment of capital, rather than, having that be one little part of spending, right? We measure it by spending. Anyway,
absolutely. Yeah, you're right. That's right. Consumer purchases. And what else are we seeing even today? And, to get into that, we're starting to see people really reach for their credit card way more often. So credit card debt is at an all-time high. So those are the folks that aren't getting those lifetime exemptions, or maybe they are, and they're just doubling it down on it or using their credit card and not their cash. I don't know. My point is that seems to, people say, oh, don't bet against the consumer. I don't necessarily disagree with that, because lifestyle is a habit, right? You get into a habit of buying Starbucks every day. You get in a habit of buying, the nicest clothes or shoes, or, having the nice cars, whatever. But at the same time, there's a limit to that. And where that limit ends, it seems to be keeping, it keeps extending. The U.S. government's not giving setting a good example on that either. But that's a different story.
Right. Yeah.
Yeah. Well, it's all part of the same story. I always come back to, it's all inflation is what I end up coming back to.
Yeah.
In the long run.
And inflation's older than time, right? I mean, that's just part of the deal. And quite frankly, if you really think about it, isn't that why asset prices move higher? I mean, I can tell you what my parents bought their first house for.
Yeah,
right?
Me too.
For $4,000 or something. It was ridiculous. And I think we sold that house, who knows, for close to 200 or whatever it was at the time that they needed to sell it. But again, what an investment. But at the same time, first time home buyers, I've got family members buying first time homes for 500, right? I mean, that's an adult number real fast. But is it really, I mean, think about that, 4,000 to 500. But who knows? My parents probably weren't making that much money, but they could afford that 4,000. This was all relative, right? Our incomes today are out of control.
Yeah.
And that's really what it comes down. That's what it comes down to, that payment. I think that payment we talked about earlier, I think people look at the payment, they go, well, we can do it. So we want to live in that neighborhood. We want our kids to go to that school. We're buying that house. So because we can afford it today.
Yeah.
So, they hope they continue to afford it.
My parents did the same thing. I mean, I don't know what year. I think my father got this big raise. He was making like 6,000 or 7,000 a year, and then he went to work for some government job, and they paid him like 14,000. He had like 4 or 5 kids already. He had no choice, right? And they bought a $15,000 house. They shot the works.
Yeah.
And,
right.
And
right.
Yeah.
More than 2 bathrooms? Oh my God.
Yeah. That's right. More than 2 bathrooms. It's like, the wife and the kid and everybody can go to the bathroom all at the same time. It's incredible.
Right.
And a garage?
Yeah. 3 bedrooms. 3 bedrooms upstairs. What the hell? Of course, they had so many kids, they had to go down and cut the garage and have built another bedroom. So, but
exactly right. It's true. You think about it, and that's a lot of people. They talk about car. I mean, don't even look at what car prices are. That to me is shocking. That's really shocking. More shocking than anything. That's shocking. So you're seeing pickup trucks going for $150,000. I mean, you better be able to make some money with that pickup truck, because if that's just for show, wow.
But it's interesting, though. It's what we're doing is we're telling the story that's told all over social media every day and in the press someplace. Like, our parents were like, one income household, plenty of kids. Some went to college. Most of us went to college, almost 5 of the 7. And the parents helped out to some degree on every single one of them. And now it's like 2 incomes and can't afford a house, can't get it done. keeping the car.
Yep.
The car fleet in the United States, as you point out, they're so expensive. It's older than it's ever been. I think it's hit 13 years or something. It's incredible.
Yeah.
Yeah,
and some people prefer those old cars, right? There's less to break. There's less sensors. There's some folks are kind of happy with that in a way. I'm in the middle of the road there. I'm not exactly sure about that, but there are some old cars I wish I could buy right now. Like a 69 Camaro Z28 or something. One of those old muscle cars, redone. That'd be great to have, but it's probably $100,000 car. And you could have bought it new for probably $5,000.
That's right.
Yeah, Dan, to your point about the housing, like not only can people not afford them, that's one thing, but just the availability. Going back to the home builders, like even I think like a younger generation would be open just buying like a normal house, modest, like what you're saying, like it always was. They're just not there. There's not the population growth has well outpaced the supply, and so it's just not even there. And so part of that I feel like is just the millennial generation finally becoming adults, and things will change eventually. But
I mean, I think so, and I think that's what we're talking about. Right? We're talking about, again, the dominoes falling in order, and that's where rates have to move first. There's got to be some relief there, right, in that area of asset. And if you think about it, I mean, we all know this, and it's been said a million times, but it is an incredible driver of the economy. Once you buy a house, you got to put stuff in it, right? And there's a lot of stuff to buy, right? There's then you're going to fix it up, then you're going to go to Home Depot, then you're going to paint it, and then you're going to hire a local guy to come do the roof. And so like all of these things, that is what keeps the economy going. But if you're a renter, you just pay the rent and call the person who owns the place when the sink leaks, right? But that person still has to spend the money, and so on and so forth. So at some point, owning real estate obviously drives this economy. And so the more folks we can get in homes, obviously that's where that stimulation comes for. And again, that's that full circle, and the dominoes falling in order. That can't happen until people can get into a home, be there for several years, and obviously support themselves and the economy at the same time. But you got to do it with a lower cost of money right now. And that's what we need, right? That's what folks are saying we need.
All right, we have it is time. Let me make sure I'm correct. Yes, it is time for our final question. It's the same question for every guest, no matter what the topic, even if it's non-financial, whatever the topic. And if you've already said your answer, by all means, feel free to repeat it. But the final question for every guest is: if you could leave our listeners with a single thought today, what would you like to leave them with?
Yeah, I think it comes down to this. So I'll start here. I think it comes down to you're listening to us because we're talking about investing in the markets. What's happening. We're trying to not so much predict, but maybe anticipate what's happening out there in the markets. And you never want to have FOMO. Right. And FOMO is the fear of missing out. And to avoid having FOMO is to be invested. And to be invested takes discipline. And I think if you're unsure about certain sectors or markets in general, whether it be the bond market or the equity market, but you want to stay invested, find something that is easy to do. In other words, ratchet down where you're invested if you're uncomfortable. If you're having trouble sleeping at night, maybe go to an index fund or stick to a high paying dividend, money market or something of that nature. My point is that don't ever feel like you're missing something. Stay invested, especially if you're young, because you've got so much time to get through this. And if you go back and look at dollar cost averaging methods over the past even 15 or 20 years, you'd be really surprised at what a certain amount of money every single month, no matter what, would have done in those timeframes. I don't think that's going to go away. And so I speak to people all the time, especially young folks, and I try to ask, are you buying your company stock? Are you investing? I don't even know how to start. And I said, in this day and age, you've got to A, start, and B, you've got to stick with it. So the takeaway is it's discipline, and don't ever try to avoid the fear of missing out by already being there.
Oh, that's a beautiful, beautiful summation right there. Avoid the FOMO by already being there. Thanks a lot for that, Pete. That was a great answer. And, you know, it's always fun to talk to you. I'm glad you could come and talk with us.
This is fun. I love this. This is great. Yep. You know, we can go for hours, but I appreciate the opportunity. Thanks so much.
You bet.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.